Well, welcome everyone to the August 2015 session of the Roundtable. It certainly is we do live in interesting times. My name is Mark Robertson. I'm founder and managing partner of Manifest Investing, and I'm joined here by one of the other three people, at least so far tonight, my good friend Ken Kavula, nationally renowned educator and small company stock picking guru. Hugh McManus was going to join us tonight, but he's been kidnapped, so to speak, by a brand new company that he's gone to work for, and he contacted us from Barcelona this morning. So he once again is across the ocean and unable to join us. Kim Butcher does intend to join us, but she got held over at work, and she may be a few minutes late. We'll keep our eyes open for her and hope that she can join us. I really kind of want to dedicate tonight to this whole notion of breaking news and what we've been through for the last 7 to 10 days. And our belief that there really is a recipe for turbulent markets. It's not terribly sexy or exciting, but it's something that we've been doing for over 70 years now, and it sure seems to work. So it's what we attempt to share and demonstrate with audiences every time we get a chance. So with that, I think I'll go ahead and jump into just a quick look at our standing agenda. If you're returning, again, a big hug. If you're here for the first time, an even bigger hug. Welcome to the show, and we do this for you. This session is co-sponsored by the Mid-Michigan chapter of Better Investing, literally an organization that has been dedicated to helping people understand and invest more successfully for several decades. This session is one of the things that the National Association and we at Manifest Investing do, and that is demonstrate and share ideas. We demonstrate where we find things and how to take a closer look at them. And this is kind of our standing agenda that we go over every month. It doesn't change a whole lot. We will take a look at the scoreboard and remind ourselves why we're here. Ken wanted to take a look at IPC Hospitalist. It's a company that's being taken out in an acquisition, and Ken probably wants to do a little bit of celebrating over that one. I would like to discuss a little bit for a few minutes the turbulent markets and just kind of kick around a few thoughts. We were talking about Lou Rukeyser in the green room a few minutes ago, and sometimes it can be helpful to lean on friends. The four companies that were charted to be presented tonight, we'll get at least two of the four, hopefully a third. And Hugh McManus was coming back with ConocoPhillips, which both was selected by Hugh and the audience at last month's session. And there will be a poll at the end. Just our quick universal disclaimer here. Again, everything that we do here is an educational demonstration. It's focused intensely on the lessons and things that we've learned over the decades with the National Association of Investors, Manifest Investing, and the Modern Investment Club movement. Everything that we do here is for illustration and demonstration, and no investment recommendation whatsoever is intended. Down at the bottom of the page, if you or a friend of yours would like to be added to the session reminder list, I know that Natalie sends out one or two reminders in advance of the session. You can write to her at nkavula1@comcast.net, and then my email address is there also if you have any questions. Dolores asked one just a few minutes ago about finding the videotaped or recorded archived sessions. You can find them at manifestinvesting.com/events. Many of them are archived there. Another thing you can do is go to youtube.com and search Roundtable. Just search for things and you'll get a pretty good inventory of the YouTube version of all of these sessions also. They're not all there, but there's quite a few of them there. All right, just a quick reminder what we're doing here. We're here sharing ideas. We try to single out pretty much a single favorite investment opportunity in each of the knights or guest damsels. Attempts to share a pretty decent idea, show you the analysis. We do expect these to outperform the market. We do use a tracking portfolio, and we'll go into that here in a few minutes, but the objective is to achieve a long-term performance advantage to the stock market. We use the Wilshire 5000 to benchmark against of 5 percentage points. So in other words, if the stock market goes up 8% over the time that we're doing this, we'd like to achieve a 13% return. We'd also like to see 3 out of every 5 as a minimum of the stocks that we pick actually outperform the benchmark index also. So with that, Ken, I thought we might just take a quick look at just some quick stock price charts and kind of where things are. I don't know. Are you getting any phone calls or anybody talking about the heebie-jeebies or anything these days?
I've gotten calls from a couple of clubs in my area that they're a little bit antsy right now, but I don't think anybody's in panic mode at the moment, at least.
You know, I think our community of investors is more immune to the panic than most. And part of that is because we do build those expectations and we do focus on return forecasts instead of prices. But even so, I mean, as calm and as patient as we are, and as disciplined as we are, this type of a price drop, which is basically going from, I don't know, 4,800 on the value line arithmetic average down to 4,200 in fairly short order. August was a very tough month. The overall stock market was down 6% for the month. So, I mean, it really can be quite trying. The market itself was down 3% pretty much across the board today alone. So these are times that test our mettle, and there's no doubt about it. The one thing I would point out, with this chart, take away all the noise and everything, take a look at this blue line from left to right. And we all know it's not a straight line from A to B, but the general trend over the long term is pretty solid. With only two moments, this one here back during the Great Recession and then that brief time during 2011 that got a little bit dicey, these are going to happen from time to time. I mean, I remember vividly listening to Warren Buffett talk about back in this time frame, his words were basically, I hope to live long enough to see another one of these, because he sees it as a buying opportunity. And oh, by the way, he just bought a whole bunch of Philips, the name's escaping me right now, but PSX, Philips, the retail side of ConocoPhillips.
Phillips 66, Mark.
Phillips 66. How could I forget 66? And here, this just gives you a closer look at that kind of that same thing over the past 10 or 11 years. The stock market's been quite strong over the last few years. We all know that. Probably stronger than it deserved, as the return forecast actually did shrink down into that 4 to 5% range, right down into here. Where we're at right now, which by the way, tonight we're at 8.7, so we're back up to here for the overall return forecast. That's actually a fairly normal level, going back all the way to 1960 when we go back and look at the value line data. But going back over the last 10 years or so, you can see there's definitely not a straight line from point A to point B. It is up and down. The fact that we stay focused on the return forecasts instead of stock prices means that we actually grit our teeth a little bit and enjoy periods like this. When the return forecasts all spike up, all of your stock selection guides end up in the buy zone, all that sort of thing. I don't see any reason to panic over what's going on right now. We're kind of drifting back to normal levels. Any thoughts on that, Ken?
I love charts like this because they remind me about what I want to do. And again, I think one of the best exercises right now that you can be doing as a club is identifying the 5 or 6 stocks that you've never been able to buy, but you've always kind of salivated after. Identify them, put them on a list, and watch them. And by gosh and by golly, 2 or 3 or 4 of them might become very attractive purchases in the next month or so. I happen to think that this is a long overdue correction we're going through right now. I don't think it's the start of a bear market, but listening to my CNBC talking heads today, I could have gotten any opinion to share with you that I wanted to share. There were people on there saying that this was going to be a bear market and everything was going to be cut by more than half, and there were folks there saying that it was like a thunderstorm in the late afternoon in Miami, that it was going to be here and gone before you knew it, and the sun would come out again. So they waxed poetic on the TV today, Mark. Okay?
Yep. I very, very rarely watch CNBC anymore, but I have watched it the last 5 days or so, just to be entertained a little. It is kind of amazing to watch. some of you do follow some of the technical stuff that we do. We don't do a lot of it. This is just trim or fine tuning in many of our opinions. This is a look at a chart. And again, you don't have to even worry about what it is. It's the difference between the new highs set in the stock market versus the new lows. And we've certainly had a lot more new lows than we've had in years. And I look at one thing on this chart, and that's the blue line kind of rolling through the entire thing. That's the long-term moving average or a trend. And I'm only going to get concerned when that dips below zero, as it did back here during the Great Recession. When it dips below zero and stays there, it's normal for it to dip during summer and into September and October. Then these spikes that you see are kind of all summertime and August, October type things. We're in one of those now. No big deal. And again, if you or you know a young person with a long time horizon, you don't even think about this kind of stuff. If you are a person that's achieved critical mass and you're doing capital preservation, you might have some thoughts here. For example, my dad, who happens to be 20 years older than me, he stays 20 years ahead of me all the time. You guys all know that. If this thing does dip down, I might move some of his more speculative investments into cash. And again, not getting wild and crazy, but as you heard Ken talking about earlier, he's got a club with 12% of assets in cash in one club. And again, that can create a real reserve for buying opportunities. And that's all I'd be looking to do with Dad. I wouldn't be looking to hide or run for the hills. I'd be hoping to capture some real nice buying opportunities with him down the road. Here's a quick reminder. I'd kind of forgotten about this chart. It's something we published at Manifest almost 10 years ago now. It's a reminder that not every month is created equal, and sure enough, the summer and September time frame can be quite ugly for stocks. I'm going to update this for one of our future articles, and I wouldn't be the least bit surprised to see September continue to be bumpy, just on the basis of history and what we can learn from history. So I wouldn't be surprised by it. So it's a fairly normal, common thing. And this chart just gives you a pretty powerful reminder of that. And as Ken was saying, find those that basket of really high quality, high potential, good opportunities, because these days are coming. Winter is coming. We'll probably write about that too. Any thoughts on that, Ken?
Nope, Mark. I'd love to see how our portfolio is faring right now. If you have the data pulled together.
Yep, we do. I want to show one last slide though, because this is a real portfolio. Well, not a real portfolio, but it's a tracking portfolio where every single decision is published in our monthly newsletter. And one of the things the reason I bring this up tonight is this is always 100% invested. It doesn't try to do any semblance of market timing. It just tries to stay invested in a basket, usually about 16 companies of high quality, high return stocks. And this is one of the reasons I say, unless you're really toward the end of your time horizon or completely risk averse, and most of us in the room don't fit that description, even in this darkest moment that many of us have experienced as investors, at least over the last 20 to 25 years, where the stock market went down 40% back here. Guys remember that, right? Took that nosedive here. Keep in mind that this was a fully invested portfolio. It stayed fully invested through the entire thing, and it only took a couple years for it to get back to even. And the amount of market outperformance, of the type of companies that we like as a community, it ought to be pretty obvious. So as this thing takes another dip down here, I actually had a professional investor quizzing me on this, saying, "You mean that doesn't bother you?" Yeah, of course it bothers all of us. But we know that this general condition is a reasonable expectation. There is no promise, there is no guarantee, but pretty reasonable expectation over the long term of working out pretty well. Because the market's going down here, by the way. When the next month is added in here, that's what it's going to look like. So it's just a reminder of, even in that darkest moment back in 2008, 2009, how quickly the stuff that we as a community like to pursue, and that's what we'll get on with here now, how quickly that recovered and how well it is done over the long term. So Ken, I think you're right. Get out there and find those 5 or 6 companies and diligently shop for them. All right, let's talk about the performance of the Roundtable tracking portfolio. This is our performance graph going back over a little more over 5 years now. We did have a tough month along with everybody else. The relative return is still positive. Again, the definition of relative return is taking our actual internal rate of return and comparing it to the benchmark. We want to be above zero, and our ultimate objective is to beat the benchmark by 5 percentage points. That's the red dotted line that you see up here. We fully expect to get here. We think it's a fairly good target to shoot for. We'd be happy, not thrilled, with anywhere in that 2 to 3% range, but we think that it is feasible, and we watch investors do it all the time. About half the stocks that we have picked out so far over the last 5+ years have outperformed the benchmark. Here's a look at the portfolio. Again, not going to spend a whole lot of time here other than to show these are the stocks that have been picked in most cases most frequently. And every time we pick a stock, be it a knight, a damsel, or a guest knight, or the audience, we take and invest $1,000 into them. So breaking this down, Cognizant Technology has been the most commonly selected, and I think that's consistent with what you found out there in your travels, right, Ken?
Well, we did some polling of the model clubs in the country and found out that almost every single model investment club sponsored by Better Investing owns Cognizant Technology. It's just the kind of stock that our community gravitates towards, and it's the kind of stock that over the long haul our evaluation tools tell us is going to be rewarding to hold.
Yeah, so in this case, we've actually selected it 9 times, 12 times. 12 times, I believe 8 or 9 of those are by Cy Lynch. So $12,000 invested into Cognizant is now worth $18,945. So that's how you can basically break that down for every company in there to measure it. And from top to bottom, I selected Apple last month. Apple's actually done quite well. 6 times selected, almost a double over the last few years. Hugh has selected Staples a number of times, and just going down the list, there's a lot of very familiar names. BioReference Labs used to be on this list, went away because of what's going on with BioReference Labs, and we're grateful for that. But the one that Ken wants to focus in on tonight happens to be Maximus, IPC Holdings, or the hospitalist down here. That has only been selected 2 times, as I believe. And you can see that it is now worth almost $4,400. So again, some pretty neat household names on there, and we want to focus in on the hospitalist for a minute. It was Ken that selected it both times back in March and May of 2012. You can see the price chart and about where he did it. And then if you look out here to the far right, this just brings the smile to our faces. Again, this is such a powerful thing when we see it happen. Ken sees it happen personally with real money more often than I, but I'm going to catch him. It's just so much fun to discover a small, promising, well-managed, I'll say excellently managed small company and, prosper and thrive from this. And here's a case where his 2 selections of IPCM have gained, have more than doubled. Each of them, bringing in 25 to 28% per year. These are annualized numbers, folks. Annualized versus the market over that same time frame at about half that level. So he has 2 relative return champions here that are, again, in that 14 to 15 range, and these are the type of decisions where that 5% advantage to the market can become possible.
Yeah. What I'd like to say about IPCM, Mark, is that those of you that are from Mid-Michigan and many of you that aren't from Mid-Michigan know that I'm a firm believer in studying stocks as an industry. IPCM, the whole idea for this company originally came out of an industry study that we did for our chapter in front of a live audience. We had 5 different companies in this industry presented by 5 of our directors. We went through the stock comparison guide. We picked IPCM, and about the time that we picked it in our event, I also picked it at the round table right here. I'm glad to say that 2 of my investment clubs and my own personal portfolio also benefited from IPCM, but it's the kind of stock that you can uncover by doing a real thorough industry study. It was a stock that nobody had heard of back in 2012 when we first started dealing with this, and it was doing things at the hospitals level that were brand new at that particular time. They were hiring these hospitalists that today are quite common in the medical field. They're people that handle the caseloads in the hospitals. But back in 2012, it was a brand new profession for many doctors. That big jump you saw in price came because the company's being bought out. And that's why I'm bringing it to you tonight to freeze the position, because this company will not be public for much longer. When it closed today, it was trading within 75 cents of what the offering price is going to be to buy this company out. And my thoughts usually are you might as well take the offer to buy it out if it's given, because if the deal falls through somewhere between now and when it's supposed to terminate, if the deal falls through, then the price will probably drop back to that 50, 51, 52 area there. And I much would rather sell it at almost 80 bucks a share rather than down around 50 bucks a share.
Yeah, this one has been a fun ride. We also featured it in our newsletter back around that time frame, so that's probably where you got the idea, Ken, but we'll let you delude yourself. No, just kidding. One of the things I do notice about the chart is the quality rating. If it's holding in an active portfolio, even outside of this transaction happening, the quality has slid a little bit, which probably reflects some of the competitive pressures involved and some of the challenges with them scaling up their business. But nothing fatal or terminal, but it definitely has come down. And it is kind of fun to see, because keep in mind that every one of those points on the chart, every price bar is literally like a monthly snapshot of a stock selection guide result, where you've got the price and you've got the return forecast. And again, back in this time frame, again, when it had Ken and his club's attention, the stock selection guide was probably in the buy zone. Why do I say that? It was basically floating around this 20% return area, and you can see with the spike up in price, it's basically down at low single digits right now. So
yeah, the SSG mark on this company has deteriorated, and it's not nearly as pretty as it was back in 2012. There's been some significant pushback from the very people that are supposed to be clients of this company. And I think that's part of what made the company, what brought it to a place where it could conceivably be acquired by another company that does similar things. The acquiring company in this case made it clear that they were very interested in the group of people that worked for IPCM, and they were going to make an attempt to run the business on a slightly different model. We won't get into any of that, but because it will be acquired, or probably will be acquired, I'm suggesting we freeze both of these line items or both of these purchases in our tracking portfolio.
Let's lock in the victories and thank you, and take at least 2 pats on the back, Ken.
Great. While we're changing screens here, Linda is asking a question about her audio fading in and fading out. I'm not experiencing that myself, and Linda, when I do experience that, that's usually a function of my internet connection. I do find that sometimes when I find that going on, leaving the session and then re-entering the session many times helps the audio situation.
Yeah, and the other thing you might do if you have any other programs running in the background, like any internet music or anything like that, Sometimes shutting them down will free up some pipe.
Or if you're using a wireless connection and you have somebody in the house that's doing significant streaming, that also causes issues sometimes with the Citrix signal. So, Mark, I don't see Kim with us yet. We'll cross our fingers and hope that she comes by before we're finished, but why don't we go to the next presentation after Kim?
We'll go ahead and save hers. I mean, I think she had some interesting thoughts to share about the company and against fairly fresh division of eBay. So spin-off, I guess, would be the best way to put it. She was going to describe that situation and how she is actually looking at it. But we'll hope that she does come. Okay, I'm going to go ahead and kick things off then with a really quick screen. Many of you are familiar with what I refer to as the ivory soap screen at Manifest Investing. If you go to the stock search function and you enter this number that you see down here, this 99.44, again, ivory soap being 99.44% pure, you basically end up with the top 1/2 of 1%, the top percentile, top half of the top percentile of all the companies based on return forecast and quality rating at Manifest. And you end up with this list. Now, there's some in here that are a little bit challenging to my instinct. First of all, Fossil, that's one that we have featured a number of times. I'm going to come back to that. Ken and I have both featured it here at the roundtable. Alliance Holdings, I'm still not ready. As much time as I've spent during my professional career with coal, I'm still not ready. And Hugh actually covered that in his presentation last month when he was talking about ConocoPhillips indirectly, when he talked about where's the future energy going to come from. I do like Franklin Resources. That one would get a second look from me, as did Fossil. Lo and behold, if Cy were here, he'd probably be presenting Cognizant Technology again. Another company that I think is worth stacking up against Cognizant is Maximus. These are all looking fairly interesting to me. Royal Gold has been absolutely just crushed lately. Again, I would be a bit tentative with that one. Polaris has been presented a couple of times, I believe, by Ken here. No surprise there. Snowmobiles, motorcycles, all-terrain vehicles. Just a really nice story of catching a pretty good wave here lately. I skipped over Forward Air. It's kind of interesting to see the night transportations and the Forward Airs and the companies like that show up on lists like this if you believe that recessionary conditions will abate both globally and in some of the geographical recessions that are going on right now. Can be a very interesting place to look. You could compare that with Expeditors International also. C.H. Robinson, which we've featured a number of times. So again, there's a number of companies, including the last one on the list there. I would have no trouble as a long-term investor adding Apple to our collection again tonight. Again, I featured it last month. It's probably down fairly significantly from last month. Haven't even looked. This is a long-term. This is not a dash. It's a marathon, and I think that Apple has a pretty good machine in place. So let's go back to the top of the list. I don't want to do Fossil again, but it's an example of a company that has been kind of beat down by perceptions that we have almost recessionary conditions persisting in this country and that consumer discretionary is under some pressure. Fossil is actually under pressure from Apple in their watches and all that kind of stuff, but across the entire sector and even down into the industries, there's a whole lot of things that are kind of roiling around, concern about the American consumer specifically, slowing down purchasing and that kind of thing. So that's one of the reasons that the stock prices have gone down and the return forecasts have actually come up, probably even more so. These were prepared before the close of business today. I'm going to actually go to a very similar company that I was surprised that we have not covered at the roundtable in over 5 years, Urban Outfitters, because this is one that can really give us all heartburn as investors. We're skittish about this one, but I basically point everybody's attention to the business model or the visual analysis graph on the right there. What's wrong with that picture? It has some bumps in it. It's economically sensitive, but we're basically talking about a company under current conditions that has a return forecast in the high teens. The price does bump around. You could get an opportunity to sell that one. We'll sell it in the future. We'll talk about something we might watch as a community. But this is one that you can really grit your teeth and take a chance on. This is an excellently managed company. Um, they really serve their demographics well, and pretty good outlook going forward. Here's a quick look at some of the landscape with respect to the profitability and the PE ratio or valuation measures for the company. Yeah, they're maturing. They're getting larger. They actually have really decent, strong margins in the 8% net margin range. Anywhere in that 6 to 8 to 9% range would seem to be a reasonable expectation. Even if you went worst case and went down into the 7 to 8% range long term, you're looking at a fairly decent situation. And again, the PE ratio over time has matured. This is no different than the PE display that you see on the back of the stock selection guide. Just a little bit longer time frame, and that actually is a regression or a best fit curve, suggesting that somewhere in the high teens uh, makes pretty good sense for this type of company also. Here's a same look at Chronicle, just like we were showing a few minutes ago for uh, IPCM. In this case, you see a company that is under some competitive pressure and maybe a little bit of a financial strength weakening over the long term, but still an excellent quality rating up there, very close to 100 for a quality rating. This is an excellent company. And you can see that the stock price has been up and down, and it's currently down. The green bars again being the stock price. It's taken a real good hammering here over the last few months. And again, as I mentioned before, the red line is basically a continuous graph month by month snapshot of the results on, you can think of it as a stock selection guide prepared by the analysts, the rhinos, of a consensus stock selection guide section 5 result. And again, the higher means it could be in the buy zone. Back here it was definitely compelling. I think we probably featured that in our newsletter, along with some of the other retailers that we may have talked about here on the roundtable. That turned out to work out pretty well over a 2 to 3 year time frame. Look at where the green bars are there. And once again, we're kind of back at here's a stock price spike down that you can see here that resulted in that buying opportunity. Some of us refer to that as a rhino spike or a rhino horn, and a spike in the other direction. Spike of the stock price spiking up here, driving the return forecast down. And again, we're back in that range of it's actually looking fairly attractive, probably ends up as in the buy zone of most stock selection guides. One of the other reasons I wanted to point this out is this is the type of company that you probably have to be willing to sell from time to time. One of the best examples that we have for this type of company is Buffalo Wild Wings. A number of us have bought and sold that a couple of times over the last 10 years. Doesn't make us day traders. It just recognizes that in economic pressures up and down, sometimes it's going to present you with buying and selling opportunities. It can make a massive difference to your long-term return performance to buy and sell a company like this a few times successfully. And we're kind of in buy mode here. Again, it's kind of gloomy. Everybody's worried about the consumer. China would have some effect on this. You're going to hear a lot about China. China could do a lot of damage to investors here in the next few months. Let's hope it doesn't get too far out of control. But one of the things I noticed from this chart is maybe this is the type of company that you could pick almost a sell limit at somewhere in that 9 to 10% return forecast range. At least put it in an alert situation where when it does get down there, you think about potentially selling it, particularly if it made sense to do so for the portfolio. Even though it's a very high quality company, it's going to have its ups and downs. You can see that from the price chart, it does have its ups and downs over time. Again, it is possible going back over time to listen to your stock selection guide, buy when it makes sense to do so, sell when it makes sense to do so, and what's the more appropriate thing. Again, keep in mind the stock selection guide was very weak at this point in the curve, and it was very strong down at these times. So again, it can make a lot of sense to go in and out of a stock like this. Again, not day trading, but just being a little bit more active, less passive with a company like this. And the last thing I'll leave you with is just kind of our parade of opinions that we do feature on many companies. You can see that our projected annual return is, in the mid to high teens, a very solid situation, excellent quality company. And then just a parade of opinions. Value Line's low total return forecast, which we think is very often the type of thing that comes to fruition, is also in the team, very nice. The Morningstar computes a fair value. So does Standard & Poor's for every company that it does an analysis on. It's kind of like an upside down stock selection guide. They compute a fair value instead of a return forecast. And then they compare the current price to that. Well, this is basically saying that Morningstar believes that this company is 24% on sale. The average company is probably in the 95% range right now. Same thing is true over at Standard & Poor's. They like it even more, 36% discounted, which to me is enough, even for this very faddish, trendy, difficult to stomach type company. And we close with opinions from the analyst consensus and Standard & Poor's and Goldman Sachs over the next year. Again, it's a very short term from our perspective, but the consensus is there. The average company probably right now is in the 20% range for these entities. So pretty much across the board, pretty good feeling. And again, I go back to an article I wrote several years ago about how if you stacked up the Abercrombies and the American Eagles and the Coaches or Urban Outfitters, those of you in the audience probably fondly remember Chico's. Those type of companies have actually been very rewarding to investors who are willing to take the chance and realize that these companies are never going to have straight price lines from point A to point B. And in this case, we're in the situation where it's potentially attractive with the recent dip in stock price from the high 40s down to the low 30s. So with that, I'm going to add Urban Outfitters to our closet and hope for better days ahead. Now, Hugh's not going to be able to join us tonight. We're not going to do his slides again. I just wanted to give a quick update on ConocoPhillips. It's actually doing fairly well relative to the rest of the group. Again, those opinions across the board, you can see some pretty staggering numbers over here on the right. They do stock selection guides a little bit differently than us, apparently. They're looking at a different time frame. I did want to share this one really quickly just to make a point before we launch Ken on his part of the stock presentations. This is a quick look at the stock search results that are focused on the 52-week low like Hugh likes to do. What I've done here is we're sorting for very high quality stocks, I believe also high financial strength, but comparing them versus their 52-week low. Again, he likes to go shopping mostly within his own portfolio, but he's looking for stocks that are very close to their 52-week low. These are all companies that are within or less than 5% away from their 52-week low. Kind of interesting to see some of these companies that are pretty tight and up against the stops. Tiffany is very interesting to many of you in the audience, and it's apparently trading very close to its 52-week low. South Jersey Industries, again, that's a fairly steady company over the years. Not flashy by any sense of the means, but could be worth a look. And again, just going down the look, I would draw your attention to the number of transportation companies, delivery type companies like UPS and JB Hunt and Forward Air that are in there. That's just a sign that maybe things are getting a little bit out of control to the downside in that particular industry group. Fastenal, I know a number of clubs that we visited recently have been adding Fastenal. It shows up pretty good characteristics here, also very close to its 52-week low. And a company that I'm going to spend a lot of time studying, and may even be the company for next month, is Joy Global. I'm going to try to figure out if that makes sense because it keeps showing up somewhere. But again, you can actually do a quick stock search and use some of McManus's characteristics. One thing I would point out is ConocoPhillips, very closely related to Phillips 66. Buffett and Berkshire just bought a whole bunch of it, about $11 billion worth of it just this past week, with a fairly routine return forecast from Value Line anyhow. And just some other stuff that we threw in here that was here. I did want to spend just a moment on this one. This is the the one that kind of grabs my attention when McManus is making the point that, gasoline and liquid-based propulsion fuels are not going away anytime soon. Again, this is on a global basis, but notice that as a percentage of the total amount, coal is expected to go down, but still on a volume basis, the coal is not going away, at least not the day after tomorrow. So that could drive us back into that industry at some point in time, not too far down the road. Notice that the natural gas is really ramping up also. So with that, let's just go ahead and jump over to Ken's presentation for tonight. This is one that has shown up on screens on multiple occasions, and I've taken a few looks at it. Can't wait to see what Ken has to say.
Well, this is a company that I really like this company. I'll preface my remarks by saying that, and I'm also going to suggest that if George Nicholson were around, he might call this company today a triple play. And I'll just go through the triple play idea real quickly at the front end, and then I'll go through it again at the back end and show you where you can go to look for some kind of things. A triple play in Nicholson's ideas was, first of all, a stock that would have a return in excess of the average, greatly in excess of the average. And at the present price, when I'm looking at returns from Value Line, we're suggesting that the par might be as much as 15% in triple play. That's a pretty decent return. But we're also looking for this triple play. We're looking for somebody to suggest that there's room for PE expansion and for margin expansion. And if I look at the Value Line sheet from Skyworks, I see that the current average PE from 2014 was 16 or thereabouts, and Value Line is projecting a return up into a 20 PE. So there's that PE expansion concept. The third point, the third leg of the stool for the triple play is net margin increase. And again, I'm looking at the percentage net margin from 2014, and I'm finding the number to be somewhere around 20%. And I'm looking at the projected number, and I'm seeing the value to be 29.5%. So I think that I have all three legs of the triple play in place. Nicholson says it should be easier to find triple plays when you're in harder markets, when you're in markets that are closer to bear territory than bull territory. And I think that's where we might be looking a little bit right now, looking at marketing correction. So I like the concept that this might be a triple play. So let's talk about Skyworks just a little bit. Their vision is simple, connecting everyone and everything all of the time. And when you delve into Skyworks a little bit and listen to some of the things they talk about, you find that every one of you probably that's listening to this program tonight uses Skyworks products and you don't even know it. Skyworks is ubiquitous in the cell phone arena. If you have a cell phone, then you're probably using one or two or three Skyworks products right inside the cell phone. And if you're also doing anything with the Internet of Things, folks, you're going to start to see a new abbreviation appearing all over the place. I've seen it appear in lots and lots and lots of investor presentations. It's a capital I and a small letter O and then a capital T. And that stands for the Internet of Things. And that's basically anything, any object that you can connect to the Internet and then control with a device like a cell phone or a tablet. Many of you, for example, might have thermostats that you can now control through your cell phone. That's part of the Internet of Things. There's also the Internet of Things attached to automobiles. So if you have a key fob and you press that key fob and it opens up your particular car and no other car. That's part of the Internet of Things. And believe it or not, Skyworks products are in those types of receptors, or in those types of key fobs. They're in all kinds of things where we just don't know the name of the manufacturer, but when we do a little bit of peeling back on the layers of the onion, we find these products. Next slide, Mark, if you would. Skyworks has been working very hard. They make a broad mix of many kinds of chips. They're in the semiconductor industry, and many of the chips that they make are chips that allow digital signals to be read by analog machines and analog signals to be converted to digital signals. Analog, you know, is words and laughter and things that you can touch and listen to directly. Digital, of course, is a string of ones and zeros that can be read by a computer and then converted back and forth from the digital to the analog. You'll notice that they've been moving very successfully in the last 3 or 4 years to higher margined products. In fiscal year 11, 20% of their products were from broad markets. That would be things like these key fobs I was talking about in the automobile, or things that help the auto avoid collisions. Those are going to be big in the next 3 or 4 years as your automobile begins to take over a lot of responsibility from the driver. Notice they've upped the percentage from 20 to 26. The margins are much higher on the broad market items. Notice that in the integrated mobile system items, which also carry greater than 50% margins, they've upped their percentage from 20% of their product line to 36% of their product line. So a strong push to sell higher margined products and to therefore raise their earnings per share. Next slide, Mark. The mobile data consumption, the amount of data being consumed by every individual on the planet, is just exploding. And those of us, and I include myself in this next sentence, those of us that use hardly any data on our cell phone are in the decided minority of people in the world today. You can see the growth rate. It's a 57% compounded growth rate for data. And you can see the companies that Skyworks works with to take advantage of this growth in data. As data grows, you need more chips. As the type of data that you're using is added to the product, whatever it is, you need more chips. So what a phone that used to have a single chip in it to deal with sound amplification might now have a half dozen chips in to deal with all kinds of data streaming in and out of the receiver. Next slide, Mark. Connected devices are also skyrocketing. You can see the smartphones being going from 100 million in 2008 to 2 billion in 2020. The Internet of Things, 6 billion in sales in 2012, up to $43 billion. That's a 7-fold plus increase in 8 years. That's a pretty vivid description of what Skyworks perceives as the growth in its business. As the Internet of Things explodes, Skyworks expects that the types of chips that it will supply to this Internet of Things will also explode. Next slide, Mark. There's mobile market drivers. Hardly anybody right now has a 4G phone. That's a fourth generation phone. The LTE stands for long-term evolution. That's a technical term that just means they're using a certain set of standards to go from the third generation to the fourth generation. They expect 2.5 billion new connections on 4G phones in the next 4 or 5 years, and Skyworks is the leading provider of these chips to make the 4G phones work. A dramatic increase in addressable content, all kinds of different content going to be coming through your phone, not just using it to make a phone call anymore. And customers are demanding that this cell phone that they're holding in their hand, or perhaps the tablet, do more and more things and connect with more and more content no matter where the person happens to be. Next click, Mark. Also, we're growing bandwidth, and bandwidth is just, think of it as how wide the highway is that you can let the information travel on. In 2014, you could see that we were dealing with $4 to $5 billion in various types of equipment. That's going to be doubling by the end of the year 2016. You can see the change in the types of modems and the types of equipment that are going to be necessary, and all of these things are loaded with Skyworks chips. Again, Mark? Wearable products are going to be expanding, compounding at about 50% is the estimate. Remember, Apple's not the only one to have wearable products. Timex is moving into the field, Samsung's moving in, Fitbit is moving in, and Skyworks is a part of all of these devices, including the Apple devices. Click again. Also, there'll be lots of new products, things that we didn't even think about in 2014 will be common sense to us by the time 2020 rolls along. The Internet of Things is going to control not only things like thermostats, but it's going to control locks and doorbells and lights and anything that's electric in your home, your refrigerator, your stove, your microwave, your dishwasher, anything that you might connect to the Internet of Things. Skyworks is going to come up with chips, and there's going to have to be chips in your devices to control this Internet of Things. Another slide, please. And they're going to increase what they're selling to people in a vertical way. So once you get your foot in the door at Ford Motor Company, for example, by providing chips for their key fobs, the next thing might be to help on their navigational assist, or it might be to help on your variable headlights, or it might be to help on the self-driving cars. And I'm just listing a few of the things that are in the news right now. I don't know if I can dream of what's going to be happening in my car in 2020. Another slide, Mark. Here's my equity analysis guide, my Eagle for Skyworks, and you can notice that it gives me a PAR of 13.3. I want to draw your attention to the, and I used all of the numbers that were come up with by the analysts right here. I didn't choose to change anything, but I want to draw your attention to the average PE ratio that the analysts are suggesting might be appropriate for Skyworks. They're using a 31, and I want to draw your attention to their sales growth. They're using about a 15% sales growth forecast, if you can see it up there. Now let's turn to the next slide. Here's the bottom of the Eagle. You've seen this diagram now, this graphic, a number of times tonight. I love when my small companies, and that's back in 2011, 12, 13, this was a very small company. This is a good, solid, medium-sized company right now, and I love when their quality creeps up into the 85, 90 area. That's where it's been, and it's been fairly consistent for the last 2.5 years. I think I'm also looking at a return at that 13% level that historically is near the highs of the returns that are available right now, or that Skyworks has seen going forward. The price has taken quite a bit of a drop from the $100 level. It's now priced at about $83 as of the close of trading this evening. One more slide, Mark. Here's my study on Skyworks, and again, I'm using the defaults. I'm letting the defaults speak for themselves, and I'm getting that par value of 13.3. Keep it in mind, it's based on a 31 PE, and it's based on a sales growth of about just under 15%. Another slide, Mark. Here's my traditional SSG, and while I wouldn't call this one up straight and parallel, I certainly like the direction of all three of the lines. I love the fact that the sales since 2009 have been fairly consistent and running at a pretty high clip. These are really steep lines. What I tried to do is take away the data from when this company was considered very small and concentrate on the data from when the company, in my mind, turned into roughly a medium-sized company. I figured that happened sometime around 2008, 2009, and that's where I'm starting my data from right there. Another click, Mark. Notice that I'm using an average PE considerably less than the 31 that Value Line or that the analysts were predicting. If you add those two numbers that Mark is circling, if you add them together, about 13 and about 27, that gives you 40, which means I'm using an average PE of around 20 rather than 31. To me, that's an extremely conservative call based on where Value Line and the analyst community think this thing is going to go. I've also used a sales rate just about at the same level that Value Line is calling for. Well, with this extremely low PE and with a sales rate that doesn't exceed the analysts at all, I'm still getting a buy with a 4-to-1 upside downside. One more click, if you will, Mark. Notice, by the way, the company carries no debt of any kind. That's that third line, line C on the section 2, no debt in this company. One more click now, and here's section 5. I'm getting a return of 15%. This is based on that $83 price I mentioned. Mark's 13% was based on a price of about 85.5. So I think those numbers are certainly both in the same ballpark. We're arriving at about the same analysis, even though we took completely different paths to get there. That gives me some good feelings about my SSG. So let's do one more click. There have been a lot of questions in the question box about this company, and I will tell you that this company has done a wonderful job of helping you get answers yourself without having to have me do all the research and then relay it to you. If you go to the Skyworks website, and instead of clicking on the Investors tab, click on the About tab, up will come this series of 3 pictures under the words About Skyworks. If you need to know the exact URL, here it is in the presentation, and you can type it into your browser and get to this same place. One more slide, Mark. Beneath those 3 pictures are these 4 buttons. You can view a company presentation. I drew about 10 slides from that company presentation to show you this evening, but there's a lot of slides there which gives you a lot of great information about the company, and there's also a series of videos. One person already in our session tonight has asked me about Skyworks' exposure to China. I would urge you to go to the Skyworks video. Jim Cramer interviewed the CEO and chairman of Skyworks less than 2 weeks ago, and asked him directly that question because the Wall Street Journal had reported that about 3/4 of Skyworks' business was going right into China, was dependent on the Chinese economy. And Cramer started his interview by asking the CEO, is that an accurate figure? And the CEO was very quick to respond, no. He says, we do have exposure to sales in China. It's closer to 20-25%. Now, that's still not a small amount, but it's certainly a lot smaller than 75%. The CEO goes on to explain a lot about his business, a lot of how they're going to grow the business, and answers some pretty pointed questions that Cramer has to ask. You can go to these videos and you can view that video for yourself, along with about 15 other videos that explain all kinds of things about the company. There's a great one in there explaining how your cell phone really works. For those of you that don't have much of an idea about how a cell phone really works, you might look at this 2-minute, 3-minute video. It's a great explanation of analog and digital and how chips have to be there to transfer the information from one type to another. One more click if you would, Mark. I'm done with my Skyworks presentation. I thank you for your attention, and I'd like us to add this to the portfolio.
Thanks, Ken. Fascinating company. I'd like to compare against my old favorite Linear Technology and see if they're lapping those guys in some way, because that was always a good company that's kind of underperformed in recent years, and this one sure seems to be, operating in many of the same areas and perhaps doing even better.
This is one of the biggest companies that I've studied, thinking it was a small company because I didn't know any of its products. And here I am finding out that its products are everywhere. It's just not branded. So I'm very pleased to study a mid-sized company with the sales growth and the amount of sales that they put together each year. It's a good, solid mid-size, and I can expect growth in the 7 to 12 or more % range for quite a while, I think.
No, it is fascinating. It's almost a smaller blend of Cisco and Qualcomm, and it's certainly a worthy study. Do you want to go ahead and run the poll?
Sure, I'm ready to get the poll going. While I'm doing that, I will also tell you that Skyworks is covered by Value Line and by Morningstar, and both reports are extremely interesting to read. I'm seeing all kinds of questions that are factual about Skyworks, and folks, maybe I'm just getting crotchety in my old age, but I've given you a way to answer those questions. I've urged you to, if you're interested in the company, to go look about the company, to listen to some of the information, to read the Value Line report and the Morningstar report. I think sometimes, and I'm not meaning disrespect to anybody, but I think sometimes we've spoon-fed information to the point where everybody expects Mark or myself or some of the other better investing educators to have the answer to every question that can be asked. I don't have all those answers. Mark, do you? I don't know.
No, I don't. I've just begun to be interested in it thanks to some of the work that you've done. This will probably be the stock that we feature this month for us, so I'll be looking at it even closer.
So here we go on managing the polls. Of course, I've just pressed the wrong button, so let's try it again. And let's try to launch that. Did it launch now? I think it did. So folks, we'd like to know, would you like to choose to place into the portfolio ConocoPhillips? That was Hugh's pick last month. We're awfully sorry Kim was not able to get away from her job to present PayPal. I presented Skyworks, Mark presented Urban Outfitters, or don't you like any of them? And if you don't, that's okay too.
Can I just call and concede
take the mouse and click, Go on, Mark.
Can I just call and concede, make my concessionary a phone call? No, this one has
So,
a lot of very attractive characteristics, more growth for the the tracking portfolio. Be an interesting company to follow.
so we're up to about 85% of our audience voting. Just take a moment and take your mouse and click. Nobody's going to know how you voted, and it would be nice just to be a participant.
Mom, if you're out there, would you please cast a vote for Urban Outfitters?
For Mark's company, yes, okay. So I'm going to just give you about 5 more seconds here. Please, if you haven't voted, just click on one of the companies and we'll see where we are. And I'm now going to close the poll. And I'm going to share the results. And there are the results.
Wow, you're Donald
I had to come back from last month, Mark, okay?
Well, this month you're Trump.
Donald, oh no, please, okay?
Well, I mean, just in the context of the numbers.
Okay, all right.
It kind of hurting the rest of the field.
So I'm going to close this poll right now. I'm going to hide it. And Mark, I'm going to go to the question panel right now and see what's going on. Bruce from Puget Sound says, we bought Skyworks this morning. Bruce, you're in good company. The Mid-Michigan Model Club is considering buying it. The Wolves just bought it. So we have a lot of interest in this company. I'm not sure that it's hit bottom, but the semiconductor industry has certainly been beat up in the last 3 weeks. Nick Strategos, who's going to be on Ticker Talk with Ann Cuniaz and myself in a couple weeks, says he just bought it as well. And Kay says she just bought it as well. So our community seems to think this is a fairly interesting stock to talk about. Bill wants to know, what are Skyworks' primary competitors? Bill, I noticed in the Value Line report and in the Morningstar report that both reports spend a lot of time talking about the fact that one of the dangers in this company is that some other company can quickly move in and take the niches that Skyworks is presently operating in. Skyworks tries to operate in niche products that right now none of the big chip holders are operating in. So it doesn't try to butt heads with Intel or with some of the other chips that go into some of the mobile devices. But I think you certainly can get a list of some of its smaller competitors where it does butt heads. I know that there's a great list of competitors on the Morningstar report, which includes Taiwan Semiconductor, Texas Instruments, Broadcom, and Avago Technologies. I think you can also get a great list of competitors from the S&P report, which I'm not holding in my hand right now.
Terry wants to go on, Mark. Finance Yahoo lists Anadigix, that's ANAD, as a potential competitor, as well as Triquint, that's TQNT.
Some smaller companies, yeah.
These guys are all fighting over slices of a dramatically large pie that's getting bigger.
Terry wants to know, does Skyworks have proprietary technology, patents, etc.? Terry, the answer is yes, but the technology is changing so quickly that a lot of the patents, a lot of the proprietary technology has to continually be reinvented. So they put a lot of money into research and development, as do many of these chip companies. I don't want to leave you with the picture that Skyworks is alone in innovating. There's a lot of innovation going in all these chips, and I think Mark hit the nail right on the head when he said they're all fighting for a piece of a rapidly expanding pie, and we might be surprised at how many companies are going to be able to carve out a fairly decent chunk of that huge pie. There's a lot of companies, but there's going to be a huge demand for a lot of what's happening. I got a cheer from Janine for telling folks to go and do their own studies. So thank you, Janine. I'm glad to hear that I have one person out there supporting my teacherish tongue latching. Okay, so Mark, I think we've caught about all of the questions right now. I'm looking through here.
While Ken's doing that, I'll go ahead and give you an idea about coming attractions. Ken and I will both be among a number of presenters in Chicago on Saturday, September 12th. That's going to be a full day session at the College of DuPage. If you're familiar with the Chicago area, we'd love to have you come on out there. That's an event put on, it's a conference put on by the Chicagoland and Chicago West chapters of NEIC Better Investing. Our next session will be again on a Tuesday night, unless we decide to reschedule it. We might have some discussion about that. September 29th coming up 4 weeks from now. And then we'll have another October roundtable right around Halloween. Ken just mentioned Bruce Ellis. Bruce Ellis is one of the ringleaders responsible for coordinating the Seattle Puget Sound Conference out in the first week of November. And both Hugh McManus and I will be there for that. And we're really looking forward to that. It's an exceptional conference. Again, it's worth coming into Seattle to check that out. I know
I'm going to be doing the chicken dance on that night, Mark. So,
that's what I understand. Yep, I've been doing a little chicken dancing myself here lately.
So, I don't know if the chicken dance is customary all the way throughout the country, but you can't go to a wedding in the Midwest without the chicken dance. And my wife and I will be at a large family wedding on the Puget Sound Conference thing, or else I would be glad to join you and Hugh at the conference.
So it'll be a good time, and we will miss you, but we'll definitely be presenting Skyworks and claiming it as our idea. We might have to share it with you.
Great. I think, Mark, that we've covered all of our questions. I don't see any hands in the air. And so, again, folks, I'd like to thank all of you for coming this evening. We had a really nice attendance this evening. We appreciate you supporting the chapter, and we hope that you learned a little bit in the process. Bye-bye, everybody. Thanks a lot, Mark.
Thank you, Ken. Take care, everybody. Get out there and grit your teeth and shop.